Here, 8 cryptocurrency type explained. Payment coins. Payment coins are the original idea behind cryptocurrency. They were created to let people send money directly to one another without needing a bank, payment company, or government to approve every transaction. Imagine handing cash to someone across the internet. That's the goal. When you send a payment coin, the transaction is verified by a network of computers and permanently recorded on a blockchain, which acts like a public digital ledger. People use these coins for online purchases, international transfers, and sometimes even everyday shopping where crypto is accepted. Their biggest advantage is that anyone with an internet connection can send money almost anywhere in the world. The downside? Prices can change dramatically in just a few hours, making them less practical for daily spending. Bitcoin, Litecoin, and Bitcoin Cash are among the best-known examples. Here's a fun fact. In 2010, someone famously spent 10,000 Bitcoin on 2 pizzas, a purchase that would later become one of the most expensive meals in history. Smart contract coins. Payment coins can move money, but they can't automatically follow complex instructions. That's the problem smart contract coins were built to solve. Unlike Bitcoin, which mainly focuses on sending value, these cryptocurrencies allow developers to create programs that run automatically when certain conditions are met. Think of them like vending machines. Insert the right input, and the correct result happens without anyone standing in the middle. This technology powers decentralized finance, NFT marketplaces, blockchain games, and countless other applications. Developers love these coins because they can build services that operate around the clock without relying on a central company. However, smart contracts are only as good as the code behind them, and mistakes can sometimes lead to costly security problems. Ethereum, Solana, and Cardano are some of the leading platforms in this category. But here's the interesting part. Many experts believe smart contract blockchains could eventually support everything from digital identities to online voting systems, stablecoins. If you've ever watched crypto prices, you know they can rise and fall like a roller coaster. Stablecoins were created to solve exactly that problem. Instead of floating freely in price, they aim to stay close to the value of an asset like the US dollar. Some are backed by real cash and government bonds, others by cryptocurrencies, and a few use computer algorithms to help maintain their price. Because their value stays relatively steady, traders often use stablecoins to move money between investments without converting back into traditional currency. Businesses also use them for faster international payments. Their biggest benefit is predictability. One stablecoin today is designed to be worth roughly the same tomorrow. However, that stability depends on the system behind it. If reserves are poorly managed or confidence disappears, problems can happen quickly. Tether, USD Coin, and DAI are among the largest stablecoins. Interestingly, stablecoins now handle billions of dollars in transactions every single day. Privacy coins. Most people assume cryptocurrency is completely anonymous, but that's not actually true. Bitcoin transactions are public, and anyone can view them on the blockchain. Privacy coins were designed to change that. They use advanced cryptography to hide details like wallet addresses, transaction amounts, or even both, making it much harder to trace who sent money to whom. For people living under strict governments or businesses protecting sensitive financial information, this extra privacy can be valuable. However, privacy coins are often misunderstood. Many assume they're only used for illegal activity, but financial privacy itself is legal and important in many situations, just like using cash. The downside is that regulators in several countries have become cautious because hidden transactions are harder to monitor. Monero, Zcash, and Dash are among the best-known privacy-focused cryptocurrencies. The surprising thing is that privacy has become one of the biggest debates in the entire crypto industry. Meme coins. Meme coins began as internet jokes, but some of them have grown into billion-dollar cryptocurrencies. Instead of being created to solve a major technical problem, they often start with humor, memes, or online communities. So why do people buy them? Sometimes it's for fun, sometimes it's because they believe a strong community can push prices much higher. Social media plays a huge role. A single viral post or celebrity mention can send prices soaring almost overnight. Dogecoin famously started as a joke featuring a Shiba Inu dog, yet it became one of the world's largest cryptocurrencies. The upside is that meme coins can experience explosive gains during periods of excitement. The downside is that prices can collapse just as quickly when the hype fades. Dogecoin, Shiba Inu, and PP are some of the most recognizable examples. Here's the unexpected lesson. In crypto, community enthusiasm can sometimes become just as powerful as technology itself. Exchange tokens. Running a cryptocurrency exchange is competitive. So many companies created their own coins to reward loyal users. These are known as exchange tokens. If you hold them, you may receive lower trading fees, access to special features, staking rewards, or early opportunities to buy new digital assets. It's similar to earning points with an airline or shopping membership, except the rewards come through cryptocurrency. Exchanges benefit too because these tokens encourage users to stay within their ecosystem instead of moving to competitors. But that's not the whole story. If an exchange runs into financial trouble, confidence in its token can fall alongside the business itself. That means its value is often closely connected to the health of the platform. BNB, OKB, and Kronos are popular examples. Interestingly, some exchange tokens have grown so large that they now support entire blockchain networks beyond their original trading platforms. Governance tokens. In traditional companies, executives and boards make the important decisions. In decentralized crypto projects, governance tokens allow the community to participate instead. Holding these tokens often gives people voting rights on proposals such as software upgrades, new features, or how project funds should be spent. It's similar to owning voting shares in a company, except the decisions happen on a blockchain rather than in a corporate boardroom. This approach helps projects evolve without relying on one central authority. However, governance isn't always perfect. Large token holders can sometimes have more influence than smaller participants, raising questions about how decentralized a project really is. Even so, community voting remains one of the defining ideas behind decentralized finance. Uniswap, Aave, and Maker are well-known governance tokens. Here's where things get interesting. Some crypto communities have collectively voted on decisions involving hundreds of millions of dollars. Utility tokens. The word utility simply means usefulness, and that's exactly what utility tokens are designed for. Instead of acting mainly as money, they unlock services inside blockchain ecosystems. You might use one to pay for cloud storage, access decentralized data, reward creators, or connect smart contracts with real-world information. Think of them like arcade tokens. They aren't meant to replace everyday cash, but to let you use specific services inside a particular system. This makes them different from payment coins, whose primary purpose is transferring value. Utility tokens can create thriving digital economies by rewarding users and encouraging participation. The challenge is that their value often depends on whether people continue using the underlying service. If demand disappears, so can the token's usefulness. Chainlink, Filecoin, and Basic Attention Token are popular examples. Together, utility tokens show that cryptocurrency isn't just about digital money. It's also about powering entirely new kinds of online services.